All right. Welcome, everyone. Thanks for coming. This is the first of the month and the first day of the month, so that makes it Intro to Fundraising. We do a different talk every Tuesday here, and so first Tuesday is Intro to Fundraising. Next week is South by South. No, next week, Ron. Next week is Intro to Accelerators. The next week is normally Intro to the Austin. I think that one's on too, actually, because it fits with South by. Intro to the Austin Startup Scene, and then the fourth Tuesday is Intro to Mentoring and Angel Investing. And so then we rotate through those every week. So thanks for coming. Pretty much every time the room's pretty full, so lots of people are interested in this. I'm Josh Baer. The presentation format for today is I'm going to play a quick 2-minute video just to give you a quick overview of Capital Factory, which will get that out of the way. Then I've got about maybe 30 minutes of a quick overview around fundraising, mostly to get us all on the same page. There's lots of stuff on the internet you can go read. It's really just kind of a quick sync up, and then we go just really open it up for Q&A, and usually do about an hour of that. That's always the most fun part, and I'll be here for that. And then we also have a guest here, Rob Taylor, who I'll introduce in a bit, who's joined us for that as well. Of course, my AirPlay just kicked out, so let me see if I can give this a second to try to get the presentation up. And we'll go. Try that again. Maybe we're presenting this off my phone. Try doing this off my phone instead, and then let's see if I can restart this and switch it while we go. Let's see if that works, which surprisingly works. Formatting might be a little off, but technology today is great. So we're going off my phone. Okay, so I'm going to play this quick video, and then we'll go from there. Maybe I can restart this while that's going. It's not going to work.
Investors, employees, there's peers.
The Capital Factory has events that run pretty much every day.
Our guys are after the meeting are like, hey, by the way, if anybody's looking to hire, come talk to us. Actually, come over to our office. It's another 40 feet here.
The entire growth of your startup to probably your first 20 employees is contained within the Capital Factory.
So whatever you're recruiting for, whatever tech stack or platform or hardware or software, or even 3D printing now, there's almost always those people coming to your office on a day-to-day basis. And you just sit around at nighttime, they'll probably give you free pizza and beer.
And you want to demo your product after the event. Well, you're here at Capital Factory.
One of the coolest meetups that I've been to at Capital Factory is the Women at Austin meetup, because I was able to network with other women entrepreneurs.
Working with other people who are in the same spot as you were there 6 months ago or going to be there 6 months from now is really cool.
The entire atmosphere is wonderful. The meeting rooms that you can reserve.
Here's a really good office environment that we take care of everything. Oh, but
Alan lost it too. Wait, oh no, my computer just took it back over. I was trying to restart my computer, supposed to be restarting. All right, sorry about that. We will get there. Just when you're into the good part of the movie too.
Oh.
Can I advance that? All right,
Austin is really becoming a well-respected tech hub, and Capital Factory is at the center of that.
We came in with this idea of like, we're going to start a company together because we start companies together.
There's so much going on here, and there's just the right mix of people here.
There's the right investors, the right employees, like there's the right peers.
The Capital Factory has events that run pretty much every day.
You know, our guys after the meeting are like, hey, by the way, if anybody's looking to hire, come talk to us. No, actually, come over to our office. It's another 40 feet here.
The entire growth of your startup to probably your first 20 employees is contained within the Capital Factory.
So whatever you're recruiting for, whatever tech stack or platform or hardware or software, or even 3D printing now, there's almost always those people coming to your office on a day-to-day basis. And you just sit around at nighttime, they'll probably give you free pizza and beer.
And you want to demo your product after the event. Well, you're here at Capital Factory.
One of the coolest meetups that I've been to at Capital Factory is the Women at Austin meetup, is I was able to network with other women entrepreneurs.
Working with other people who are in the same spot as you were there 6 months ago or going to be there 6 months from now is really cool.
The entire atmosphere is wonderful. The meeting rooms that you can reserve.
Here's a really good office environment that we take care of everything. Oh, by the way, there's free snacks. Oh, by the way, there's this managed conference room situation.
Well, one of the best resources here at Capital Factory is the office hours.
The Capital Factory Mentor Network is now so big, and the number of people in almost every industry vertical are there now, and most of those guys are entrepreneurs themselves.
And you meet mentors, you meet other entrepreneurs. Like for us in particular, I met my co-founder here.
I met my co-founder up here.
There's just a real critical mass down here.
Our developers went to one of the development meetups and we met our newest developer, Kyle, there, and we hired him.
The Capital Factory was with us for 2 years of going from that sort of ambition to the actual reality of having a successful company with like, a significant amount of money raised and like a high functioning team.
You know, technology is just as much about community as anything else.
You become part of this national family of people.
All right, hopefully we'll make it through the rest of the technical difficulties. My computer's still restarting. It's funny watching that video. We probably made that a year ago or so, and Rob will remember some of this, but you look at the companies that are in there now, and the ones that we happen to highlight at the time. Cratejoy has now raised, I'm sure, more than $10 million, and they're killing it. They're across the street. And then Nate was up there talking about meeting his co-founder, and they've sold that company to Big Commerce since then. And then Own Local, we was talking about bringing people over for hiring, has like 50 people over there now. They're ready to move out. They need to get their own spot. But it's interesting to see how they've all grown since then. So again, that's not the right presentation. Almost through the end of the technical difficulties. How to meet investors in Austin. We won't watch the video again. This is the right presentation. Okay. So, fortunately, we do a good job getting the word out because you guys are all here and most of the seats are taken. But part of that's through people hearing about it. So my ask of you is that hopefully through this whole conversation today, somebody, probably not me, but maybe Rob, will say something worth repeating or worthwhile. And if you could post that to Twitter or Facebook or somewhere else and encourage people to come here, we really appreciate you getting the word out. I promise you, I am not making any money with all of you paying $10 to come here to do this. This is more just that we really want to help get the word out to people who need to know about it. So the best thing for that is ATX Startup Scene or atxstartupscene.com. That has all the different events and things that are going on here. If I could use my phone, I normally take a picture of all you and post it, but I can't do that and give the presentation. So, how to meet investors. This is intro to fundraising. I'm playing with the title. Like they're all kind of intro to something, but I realized what intro to fundraising really means, and most people want at this point, is the first step is like they come in knowing I want to meet investors, and so that's really a big part of what this is about. You can find all of this online. Again, atxstartupscene.com. I change these slides every month because things are always changing, but there's some recent version of the slides all on slideshare.net/Joshua Bear. And then all these talks that we do are recorded and streamed live over the internet. There's a camera on the ceiling there. And hello. And so not only are these up here, but then all the ones we've been doing, because we do this every week. And as much as you'll hear me say the same thing over and over again, there is different guests that are up here every time. So all the Q&A is different, with different questions and different people and often different venture capitalists or other people up here that are worth going and seeing. So we're going to talk about a bunch of different things. you should really go do your homework online, right? Like the internet is huge. There's lots of people talking about fundraising in lots of different ways. There's lots of people that are a lot smarter than me and have done much other stuff. So before you kind of like, you know, dig in, the basics are all, these are the places I would go to get the basics. Kind of seminal blog posts. Paul Graham, one of the founders of the founder of Y Combinator, his kind of big epic post on fundraising in general is the first one. Venture hacks are the same people that created AngelList, and their kind of beta test or alpha test for AngelList was they created Venture Hacks, which is a blog all about fundraising and startups. The VC economics post is really good because it explains to you how a VC works and how their fund works. And most entrepreneurs really have no idea how that works. They just go beg them for money, and it's really helpful when you're begging for money to understand what they're trying to do and how you fit into that. And then Sam Altman, who's the new president of Y Combinator, this is a great interview that he did with Mark Andreessen and Ron Conway. And then he has a playbook he put together, which is kind of like an ebook or like a web page book, all about the startups and fundraising. That's really helpful. So those are some really good resources to go read on your own. Here are 3 really good books. Get Backed. It was actually just recently released. It's written by 2 Austin authors. That's not why I put it up there. It's a really great book. But that's Evan Baer and Evan Loomis. Evan Baer, his name's spelled almost just like mine, and I invested in his company, but we're not related. And it's basically like the plan for putting together your pitch and your pitch deck and going and pitching your company to investors. So really good. Venture Deals is by a guy named Brad Feld. He's one of the founders of the Techstars, and his partner Jason Mendelson. Venture Deals is like the Bible for venture-backed startups and investing and things like that, and so everybody refers to it. It's really it's got all the basics. And then Startup CEO is by a friend of mine named Matt Blumberg, and it's just a great overview of all kinds of things about being a CEO, but in particular he covers the fundraising process in the early stages. So first, I'm going to talk real quickly about what's different about fundraising in Austin, because again, all those other things you're going to read will tell you about fundraising everywhere. So what's different about fundraising here in Austin? A couple things. You know, first of all, it's funny actually. The first thing I'll say is what's different about fundraising here in Austin. What we're going to say is different is actually pretty much what's different about everywhere that's not Silicon Valley, which is what everywhere you're going to read about is about. And everywhere you go, and I've been fortunate to I've been traveled all over the U.S. and through a lot of different parts of the world, meeting in different startup communities, and it all sounds the same. Everybody thinks like the things that make them really unique or different are actually unique and different, but they're not. They're all. This is what it means to be a smaller startup community, and it's pretty common. And so, but we'll just say it's what's different about Austin right now, because it'd be different from what you read about. So first of all, it's a bootstrap first kind of place. There's that mentality here, and that means that really you're expected to go do something on your own first before people are going to throw a lot of money at you. And there's a bunch of reasons why that happens. First of all, that's just the general trend is it's getting so much more, the costs of doing a startup are dropping so dramatically and have been for the past 20 years that it's democratizing. It's great, like more people can go do a startup, but because of that, more is expected of you. The bar is higher before someone's gonna go give you a bunch of money because anybody can go write an app in their garage or do other things like that. And so you need to do more. You have to prove more to be able to go do that. Whereas maybe 10 or 15 years ago, you didn't have to do that. You might be able to put together a big pitch deck and get someone to write you a $5 million check. That just doesn't happen as much anymore, especially for a first-time entrepreneur. If you've built a big company, or if Rob wants to go start, like Rob just did, join another company in the past 2 years or two, and when he did, everyone threw money at him because he's done a bunch of other companies, and everybody else was like, oh crap, I want to get in on that deal. But if you're a first-time entrepreneur, you probably need to go do more stuff first. Going right along with that is they're very revenue focused, so they want to understand how your business makes money. And this has been actually a big debate in the blogs on Medium recently over the past few weeks. There's a lot of people talking about it and complaining that Austin investors aren't willing to bet on these big bets or certain types of companies that maybe are more consumer internet focused, don't necessarily have a clear revenue model right away and more focused on users and growth versus profits and revenue. Again, that's everywhere that's not Silicon Valley, maybe New York City, but really it's just about everywhere. And a big part of that is because no investors here have ever invested in a company like that that's gone and made a lot of money or become really big. So they've never seen it happen before, so they're much more hesitant to go do it. And all we need is one. If one of those happens here, everyone's going to want to go invest in those. But that hasn't happened, and that has happened in Silicon Valley. People are ready to take invest in those kinds of businesses and take those risks. So that's a pretty common trait. And as I mentioned briefly before, favors experienced teams. If you've done this before, you get to break a bunch of the rules and you get much more slack. That's just the name of the game. It's been like that always. So how to meet angel investors. Here's a quick step-by-step, and this is super basic. You might think this is totally obvious, but this is like literally like, well, okay, what would I do if I was getting started and I got starting from scratch, I want to go meet some angel investors. First thing is, I would leverage my personal network. And and that's really kind of obvious at some level, right? Like reaching out to people that you know, but it's something that I think most people immediately overlook. They think reaching out to people they know is reaching out to like 4 people or like 5 people, like their parents, maybe like somebody they used to work for, you know, and like a friend of theirs. And that's not leveraging your network. Leveraging your network is like talking to everybody you know and then asking them for introductions to everybody that they know, and then going on LinkedIn and looking for everybody that you know and the people that they know. And then like, you know, it's a pretty extensive process, and it's worth putting a lot of time into, because that is how this world works. That's how people work, and there's nothing better than a personal introduction. It's always going to be better to get an introduction from somebody that somebody knows, even a step or 2 away, than just making a cold call. So it's really worth investing in that, and I just feel like most people that I see don't do nearly enough to go do that. They don't leverage that enough. The next thing is just kind of obvious. Again, go where the investors are, right? So you need to meet them. So you need to go places where they're going to be. This was a good start because lots of investors come here, but there's lots of other places they go. There are certain bars they hang out at. There are certain coffee shops and events. There's certain pitch events, things like that. South by Southwest. There are places where you know that you're going to meet investors. And when I talk the intro to the Austin startup scene talk goes into more about even just some of the things in Austin about certain, again, what are some of those coffee shops or places to hang out or things like that. And there's another blog post that is the URL shortener bit.ly / plug into ATX startup scene, and it's like it lists a bunch of those there as well. Follow them on Twitter. I keep a Twitter list of a whole bunch of Austin angel investors. Following them on Twitter gives you a way to both get to know who they are kind of a little bit and see what kind of things they talk about or engage in that conversation. If you want to go approach an angel investor, it's way easier if you know them some other way first, or they recognize your face or your Twitter handle, or you've been talking to them, or they think you're smart and you talked about something else. And then you're like, oh, by the way, I have this, startup idea I'd like to talk to you about. So that's another great thing to go do. Create an AngelList profile. So AngelList is a website, angel.co, and it's basically like LinkedIn, but for your startup that wants to raise money. And so it's a social network that connects investors and entrepreneurs and startups. It's global. It's all over the world. It's great in Silicon Valley. It's particularly great if you're not in Silicon Valley and you want to connect with other people other places. So you want to go make a profile on that site and use that. There is an Austin Angel Investors Facebook group. It's not super active, but there's a couple hundred people on there. That's another place where you can post what you're working on. The Central Texas Angel Network, which I'll talk about a little bit more, is the local angel investor group. And so it's a formal group that meets every month and that has a process for applying. And they do office hours every month that you can go attend, and you can basically get advice for 10 minutes at a time from a bunch of different angel investors. That's an easy way to meet them in a kind of low pressure environment. We do a similar event here called Epic Office Hours, which we'll be doing once a month here in this year. We do a different kind of one for South by Southwest, but then basically every month there's a big event where anybody can sign up, and there's a lot of mentors and other people to meet and help. And then that's a reason why a lot of people sign up for an accelerator, is often because they want to join they want their fundraising and they want to meet investors. And a lot of times what accelerators do is help get you ready for investment and then help make those introductions. And then the last thing I wrote was participate in pitch events and competitions. So there's lots of pitch events and competitions. We generally encourage our startups to participate. There's a good way to get exposure, good way to get practice and attention, but it's kind of last. All of those other things are more important. Very rarely do I see somebody go to a pitch event and go raise money at the pitch event. It's great publicity. Like there's a lot of other good reasons to go do it, but really it's really these other things first, and really, like I said, starting with your personal network. All right, so step by step, a couple more things. One, like I said, do your homework online. You make some kind of like one-pager PDF. Like you're not writing a huge business plan. You're trying to summarize your business pretty concisely. You want to find somebody you know that is friendly. Go talk to them about it. Get some feedback. Don't go to like the person you need, the one person that you're most excited about meeting. Don't go to them first. Go to like somebody else and get some feedback. Then you're going to use that feedback, put together kind of a real pitch deck, look at like Evan's book, Get Backed, and get lots more feedback. That's an iterative process. You're showing it to somebody, you're changing it. You're showing it to somebody, you're changing it. You're like just constantly changing. And then hopefully somebody says, suddenly in that process of iterating through it, somebody like says they want to invest. That first one's always the hardest, and you get your first investor. And so then you get a first few angel investors. That's probably on a convertible note. Almost everything early stage is on a convertible note.
So what's a convertible note?
I'll go over that some more, but there's basically two ways you can raise money. It's two general mechanisms where you're at a form of the investment, and an equity investment means you're officially giving them a certain percentage of the company, a certain amount of stock, and a convertible note is it's technically structured as a loan that will convert into equity at some point later. That's why they call it a convertible note. And so the intent is it's going to become equity like something else, but it's a much lighter weight, easier thing to do that when you're just getting started is very common. And it's also used as a way often to bridge from one round to another later on. But very common early on that your first investor that often might write you a $25 or $50 or $100,000 check would, rather than going through all the work and paperwork of doing an actual equity financing with a lawyer, or well, you'd still use a lawyer, but with a much more involved process, would be to do this convertible note. Right around that time, you're probably might be applying to an accelerator. Typically, you're going to apply to an accelerator not with like just an idea, but actually with something built and a few maybe some of your initial investors, and then hopefully at some point you go raise $500,000 to $1.5 million from angel investors, angel groups. Like it's like a bunch of different people. Hopefully somebody hopefully there's like a $500,000 check in there, or a couple of $250,000 checks. A lot of times it's like a lot of $25,000 checks and $50,000 checks. And then your Series A is a couple, millions of dollar round from a real VC. So there's like a million different ways this can happen. This is like not at all like the only way it can happen. This is just, but everybody wants to know like how, like what is, and this is probably the most common way. This is the most common thing I'd see from, lots of startups coming through here. Ideally, you can skip steps. If you can go right to like raise, I know one startup we were working with, they had the founders put in about $300,000 of their own money, and they got a basic thing working, and they went out and got a VC to give them $5 million. And that's awesome to do if you can go do that. They also had started like 2 other public companies and done a bunch of other stuff, and they were in a good position to go do that. So I said follow people on Twitter. Here are some of the people I follow on Twitter. Melly Price. I'm not going to spend too much time on these, but you may have heard a bunch of these. Joel Trammell, Brett Hurt, Andrew Busey, Dan Graham, Clayton Christopher, and this is what an AngelList profile would look like. This is like your LinkedIn profile for your company, the little pitch video, other information about the company and the team and your traction. Office hours, I think I kind of went through all this already. Office hours, when you're doing these office hours meetings, this is a chance to go meet with maybe 3 or 4 different people in an hour. Think of it as speed dating. You're not going there to pitch them your company and expecting them to invest. That's not why you're doing office hours. You're going there to meet people and establish a relationship. You're looking for somebody that you connect with, and then you want to go meet with them again. That's your whole goal. It's like, is there somebody here who I want to meet with again, or who wants to meet with me again? And so if you're going to make the best use of it, try to figure out who you're going to meet with and actually do some research. It's going to be a short meeting. They're going to be super impressed if you come in with knowing who they are and what their background is and having a few specific questions for them. That's going to make you look smart and well prepared and probably get a lot more out of it. So there's a bunch of ways that you can go do that. And again, what you're really looking for is a follow-up meeting. You don't say like, are you interested in investing? You just say, hey, do you want to get together for lunch in another week? And I can show you maybe they asked you some questions or asked you to do something. Like, hey, can I come back and meet with you in a week or two and show you what I did and show you what the results were? Like, if they don't want to invest, they're definitely not going to take another meeting with you. So that's a good litmus test in the middle that's easier. And most people aren't going to invest just for meeting you once, so you want to get to do that. Another question a lot of people ask is, should I bootstrap or raise venture capital? It looks like I need to work on this slide, but I don't know if you can see the lines through here. But this is a really great chart I stole from somewhere that I thought was pretty helpful. And so how you think about this as far as bootstrapping is, building a business without taking outside investors. Venture capital obviously is, the trying to really scale very quickly. The 2 biggest vectors are how scalable is this business and how much money does it need to grow. Some businesses you can start with very little money. Some businesses are great businesses but might not be able to ever get that big. And venture capital is really for businesses that need a lot of money and can get really big. And that's why you want to give them that money soon. If you have a business that doesn't need a lot of money, there's a lot of advantages to bootstrapping. You might want to bootstrap it and not raise any external capital. If it takes a lot of money and it's not very scalable, then it's probably just not a very good business. But then if it's kind of up here and it's very scalable, not that capital intensive, then you start to look inside of that of, well, how competitive is it? Like, how easy is it for someone else to come compete with me? And again, if it's not actually very easy to be other competitors, you might still bootstrap it because you kind of got some time. You can work on it and you don't have to worry about it. If it is very competitive, it's easy for other people to compete, then you're more likely to want to go raise venture capital so that you can move more quickly, so you can go after it more aggressively. But I found that chart pretty helpful. And then, sorry for the formatting on this one, that's the iPhone. These are all the venture capitalists in town here in Austin. It seems like almost every time I do this slide, I have to change it somehow. There's new ones coming. I know I added like 3 after last time. JD, you can spot me on this one. But you can see that most of them focus on tech. But there's some other things in there. And there's ones that focus specifically on consumer packaged goods or health. Sarah's company, Sarah's firm's focus has kind of like a female founder focus. Most of them are Series A, so they're looking to put in, millions of dollars. Probably $1 to $2 million is the most common. Most of them, if they really like you, might put $250,000 into a seed round. That might be a way they get to know you. They don't do it a lot, but they do that too. And then Build Group is really the only one that's focused on Series B, so scaling companies. S3 is maybe somewhere in the middle. They just did, they do some larger rounds. But yeah, most of them are really Series A companies. They'll give you an idea of some of the different ones. Silverton, Live Oak are probably the 2 most active. Techstars is Techstars Ventures, so there's a fund besides the Techstars Accelerator, and Jason Seitz is one of the partners there, and he's here in Austin. I know of another firm that just hasn't been announced yet that's definitely be a significant large fund that'll come out in the next month or 2, and I'm 100% certain there'll be at least one more that I don't know about. So in general, I feel pretty good about that. I feel like even just 2 or 3 months ago there were 3 less on this, and it's been growing. And then here are the different accelerators in Austin. Definition of an accelerator here is one that gives you money, so where you can get funding. There are a lot of other entrepreneurial training programs in different types, and there's a lot of resources for entrepreneurs in Austin, and the words get mixed up a lot. So that's my definition of the word. There's like I said, there's a lot of other things that you might be able to include, but these are programs designed to help you prepare for funding and growth, and that come with some kind of funding with them as well. And you can see they all have different amounts of funding and take different amounts of equity. They often have different rules for how they take with equity, and some of them take on convertible notes or as grants or as other things. And this was my best estimate of about how it usually works out, like with real companies going through it. But it's not exactly necessarily that for everybody. And you can see that most of them have different focuses. Techstars and Capital Factory are the 2 focused on tech, but then there's health and CPG and social good companies and other things like that too. Central Texas Angel Network, I mentioned them briefly, but it's pretty awesome that we have them here. Obviously it's a group of more than 100 angel investors. They go through deals together, so you apply to the group. There's a screening process. It's about a 2-month process. Every time they go through that process, you go through stages where you get narrowed down until they get it down to like 4 companies that get to come pitch the whole group at the very end, and then they negotiate the terms as a group, and then they make actually individual investments. Different trade-offs to doing all this. Like I said, if you could do anything you want to just skip all this and just go raise a bunch of money from a VC. Lots of people I meet, that's not an option for them, and they're kind of looking for whatever money they can get. And this is a great option for filling in that round with that angel round as you're starting to go. What you're going to find is, as an example, the difference, for example, in some ways, Capital Factory is an angel group, right? Like our mentor network is really an angel group. We just don't really call it that, and that's why a lot of people come here is to get funding and get access to our funding. But the difference here is our investors all make decisions individually. So you meet somebody, they might decide, you have coffee with them, you have another meeting with them, they might decide to invest, they do that on their own. We talk to each other, but there's no formal collaboration. Everybody's operating independently. And as a result of that, that's actually a big advantage to you because you're not negotiating against a group of people. And also, people can make decisions faster and more easily. And the types of investors here tend to be the earlier ones. They tend to be the first investors. So typically, and it's very, very unusual that someone would get a C10 investment before they got an investment here. It's much more common to work the other way. They would come here, meet investors, get some credibility, and then go apply to C10. And then through the C10 process, the nature of a big group making a decision is they're more conservative. That's just like human nature too, because you have a bunch more people pointing out reasons why it might not work or other things like that. From the investor perspective, that's very helpful because they have a bunch more people doing due diligence and advising each other to help them figure out what the best deals are. And then when you're figuring out the terms, you're negotiating against a group of people. So it just goes, it's a different process. It goes slower. It's generally a little bit more conservative. But it's a great option that we have. And they can put together rounds of hundreds of thousands of dollars, and then they can go syndicate them out to other angel groups in Texas to even get them to be larger. So they can kind of act like a mini VC. And this is just kind of, I tried to map out just all the different ways you could get money, and I said work backwards, meaning kind of like ideally you want to get the people that are the most value add and give you the most money, so you kind of start up here and work down. But really most people start down at the bottom and work up. That's just, you usually don't have those choices. So, if you don't know where to go, you go to your friends and family. Those are often the first people that end up giving you some money. I've kind of said, well, an angel investor is kind of more value add. An angel network might get you a little bit more money, but you're dealing with kind of the group, and accelerators can be big value add, not a lot of money. And venture capitalists, generally going to be the most. There's lots of people that argue all kinds of bad things about venture capitalists. I'm not trying to make them say that they're the best thing in the world either, but on these vectors, that they're there. And usually, if you have the choice, you'd rather go get money from a venture capitalist first than doing all those other things. Okay, another big question we get is valuation. So how do you value your money, right? Your company, what's it worth? And everybody wants to be worth a lot. The average valuation here in Austin is $3 million. No question, that is it. Because most companies have nothing, and there's no reason they should be worth anything. But you have to come up with a reason for them to be worth something. You have to start somewhere. And that somewhere is $3 million. And if you're if you feel like your company's maybe not as far along, your team's more inexperienced, or you just want to make it really easy on yourself, you might lower that a little bit. And so if you came, because that's the market's kind of at 3, so if you're coming in and say 2, people are going to notice that and are going to find that attractive. If you are trying to push it a little bit, you might push it up to 4. That's not uncommon either, particularly if you have maybe some traction, you've got $10,000 a month in revenue, which isn't a lot, but it's something and shows that it's working. But it's going to be that kind of a range. And that's probably about half of what it is in Silicon Valley right now. And that's a whole other whole discussion. I don't think that's necessarily better or worse. I know some really smart people that generally say that the only valuation that matters is the one you sell at, and that actually there's a lot of reasons structurally for your company. It's good to keep that valuation as low as possible until you sell it. Not as low as possible, but it's not necessarily always a game of just driving up as fast as you can. And if you do that, that can cause a lot of problems for you later. But no question, we are not in a bubble. We are pretty steady. So if you're doing a convertible note, which we mentioned before, the note will generally have a cap on it, what is what's called a cap on the note, which is the highest value the note can convert at, and that protects the investors from the valuation going up too much. And so you're just going to generally think of the cap on the note as the valuation. These numbers would work about the same way. And you're going to get a higher valuation because you have a lot of traction or you have a good track record. So a very experienced entrepreneur starting their next company might get an $8 million valuation or a $10 million valuation or a higher valuation because they're going to have more investors competing to be part of that deal, and they have different kinds of credibility. And then another interesting thing is you can just get a higher valuation just because you need more money. And that sounds really counterintuitive to most entrepreneurs getting started. It doesn't make any sense. But if you're building a very capital intensive business that needs $10 million before you can get started, then you have to have more than a $3 million valuation. It just doesn't work. And the general rule of thumb is that the investors in each round are usually around a third of the company. And so you kind of at some level can say, well, I need this much money, and so my valuation is going to be 3 times that. And that's probably a really good starting point, as strange as that may sound. And another rule of thumb is if you have to justify it, it's too high. So when you're talking about your business and you're talking to investors, you should be talking to them about why they should invest in your business. And then when you tell them what the valuation is and the terms, they should just say, awesome. That sounds great. And if they're not, then you should like lower your things, because the debate, there is, especially at these early stages, there is no reason for you to debate anything. You really have almost no argument that it should be higher or it shouldn't. So that's not a good argument. You don't want to get into that argument. So you just need to be picking a number that people go with, and that's kind of it takes a little tuning, and you might have to say it a few times, but that's really it. Another great quote I saw on Twitter recently from Jose Inser, who's a local attorney, and he said, the best term sheet is the one that gets signed. And so you can negotiate yourself out of getting stuff done a lot. So, and like I mentioned before, bigger is not always better. A couple more things real quickly. How much time does it take? It usually takes 6 to 12 months to raise funding. So you're thinking, if I'm going to run out of money 6 months from now, you better start raising money right now, like really fast, because it takes a long time. And it sometimes can go really fast. Again, often if you already know people, or it's coming from a small number of investors or just one investor. Like I said, it can only happen in a month if it's just a few people, but sometimes it takes a lot longer than that. And a lot of times it ends up being like, it's not like, okay, on this day I'm gonna get $1 million. It's like, crap, I got somebody to give me $25,000, and then like you end up over the course of a year, you're like fundraising the whole time, which is a big distraction and not preferable, but it happens a lot. So something to keep in mind.
Can you walk us back off the cliff just a little bit? So when you say for like 18 months, you're typically talking about like an A round after you've already taken the seed round, right? Or you even talking?
No, I'm saying just lots of times, like someone's trying to raise $650,000 or $750,000, and like, especially one of the nice things about the convertible note is it can allow you to not have like one big closing date. And it's actually, you can do that with any kind of thing, but it's more common with a convertible note. So that allows you to have somebody say they want to invest and be like, great, you can invest right now. Give me the money. And you're not like waiting for other people. But that means, okay, great, I got $50,000, but now I got to go convince more people, right? And you can get yourselves into like a month-to-month kind of situation where like every month you're getting a little bit of money and it lets you keep going, but you don't actually ever get to your big number.
So that round, it might collectively take 18 months, but you've been through the convertible notes, you've been taking checks all along.
Yeah, you're collecting money the whole way, but it sucks. Like not enough money that you really want, and it's very distracting. And then a lot of times, if you don't get a big chunk of money at once, you can't move aggressively. So it's not great. I'm certainly taking 18 months isn't great, but it does happen quite a bit. And some of those companies end up being successful. And I'll tell you what I see, and I'm not trying to be so discouraging, but just to make it real. Like I've seen a lot of companies that come and they spend a year kind of chasing their tail. It's like they got a little bit of money, and fortunately the ones that do this are ones that keep their costs low, so they can do this. But they spend a lot of time trying to figure out where they're going and find their sweet spot, and then something clicks, and and both investors start coming on and they start to hit their stride and they grow. But I've seen that happen with a lot of companies, even some of the most successful ones. Cratejoy pivoted 3 times before getting onto what they're doing now, which is really, really working and is really good. Aceable is another one that's really doing well, that went through here and is doing very well right now, but spent a year with slightly different ideas and slightly different versions, and I couldn't have predicted it. Like I love Blake, but I wouldn't have told you when he first came in here, oh, that's gonna do what it did. Like so it's hard to predict. And like I said, lots of times it does happen faster. A lot of times it happens in 2 or 3 months, but it's not 1 month. And it's like at least 3 months, and it's probably 6 months, and that's when things go well. And most people say no, like over and over. And so fundraising is just getting told no over and over until somebody says yes. And it might take 20 or 30 meetings to get somebody to say yes. And then usually once some people start saying yes, it gets easier and more people say yes. But you really have to get you have to have really thick skin, and it's very discouraging, and yeah, fundraising sucks. There's very few people that like fundraising. So the easiest way to impress an angel investor, and most people, but particularly angel investors and investors, is to say you're going to do something and then do it. This sounds so obvious and so easy, and it is so difficult. It is so hard to predict anything that is going to happen in your company at the early stages, and it is so hard to predict at all what is going to happen next month. And almost all I hear is complete bullshit, like from anybody. And they just have they think so much is going to happen in the next month. They have so many goals and so many priorities, and that does not make you look good. That's not being ambitious. That's being stupid. And that is And what's going to happen is then what it shows is you can't predict what's going to happen, which means you don't have credibility predicting how you're going to make money or other things like that. And it shows that, and so by being able to do this, by telling investors, hey, over the next month, my focus is going to be do this, this, and this, and here's what I'm going to do, and I'm going to come back to you in a month and show you what I did, and then coming back a month later and saying, hey, remember we met before? I said I was going to do this and this. I did this, here's where I got to, I did this, didn't quite work the way I thought, here's what I learned, I did this other thing, was able to accomplish this and this, and having that internal accountability to yourself and to them is very confidence building and very unusual. And so I really just stress that. I'm not saying you want to like sandbag it, but you do want to actually cut back, don't overcommit, undercommit, make sure you deliver, make sure you show them you delivered, and you want to establish a history of doing what you say you did. That's how you get money. Because then, like, if you do that and then you say, here's what I'm going to do next, and it's going to make money, then people are going to believe you. So that's it's like I said, kind of an obvious thing to say, but it's actually really, really difficult to do in a startup. Mark Sister, who's a really famous investor from LA, he wrote a blog post a long time ago. This is from 2010, and he described it as, I invest in lines, not dots. And this also gets back to, like, you don't just meet somebody and they invest, unless it's me or somebody stupid. But normally it's you meet somebody and that's the dot. That's a dot on the graph. And so now they know where you are right now. And that might look great. But what they want to see is like a couple more dots, right? Because then they want to see, like, well, the next dot's here, and ideally the next, okay, now I see a line. And that line's going in the right direction, and that feels good. But if it's this, or it's this, like, that's not so good. So that's part of knowing it's going to take multiple meetings and saying that you're going to do something and then going and doing it. Okay, so that's the end of the intro slides. So hopefully that was a good beginning part. And we've got about 45 minutes more. Rob, you want to come up and join me up here? Rob Taylor has been involved in a bunch of different businesses. When I first met him, he was, I think, still at TrueCard, which is a company that went public since then. And he also is a very active mentor here at Capital Factory, at Techstars. He's an angel investor, and in what I consider to be a huge success for a startup and an accelerator. I've seen this happen a number of different times here at Capital Factory and other places, and with TrueCard's X, interestingly enough. He actually became the CEO of one of the companies in the Techstars class that he was mentoring. And so he got involved with it and got so into the business and was helping them a bunch, and actually stepped into the CEO role right as they were raising their Series A funding. And I think they were a great company and I really liked them, but I bet it was a lot easier for them to raise their Series A funding with Rob, saying Rob was going to be their CEO as part of that. And that was really great for them. So I really appreciate you joining us here today, Rob. And like I said, this really just becomes a Q&A, or, I'm going to skip the slides here, the AMA question about, they're really just kind of ask me anything. So if I have the slide I want, which I might not. Oh, further down. Great, there we go. So yeah, just love to open it up to Q&A. You guys can ask us anything about, and this can be obviously about fundraising. You can ask. I'm happy to answer questions about Capital Factory, or about anything about, if you know Rob or me or anything else, any of our personal experiences, or anything about your own startup that you're trying to do.
So say you have an investor on the hook, and they say, "I've got 50 to 100 for you, but not until July."
You don't have them on the hook.
Okay. So, would you try to push that and say, okay, can I get you to sign a letter of intent? And then would you go about saying that you've raised the money at that point if they sign that letter?
I don't feel really good about that. I've just seen more often than not, that's not going to work out.
Okay.
So I wouldn't, that's like counting your chickens before they hatch.
I agree, especially if it's an angel investor. That's just sort of not how it works, right? I mean,
it's not a commitment.
It's not a commitment, and
Oh, my pool leaked. I gotta do my pool. Like,
yeah.
Like all kinds. Something can happen. All kinds of things can happen. Even with the VC, I just that's not a commitment. That's so
too soft.
Yeah.
Okay.
Yeah.
So I push them, and unfortunately, the only push you have is competition. So it has to be that you have other people interested in doing it, and that basically effectively the price is going to go up over time. That this is and that's the ideal dynamic that you want to have, but you can't always have.
Yeah, I mean, the one thing you can do is ask that investor is if they're comfortable with you saying that they have that commitment from them, that you can leverage to talk with other people, right? Because that's the other thing about, you know, angel investing, right or wrong, it is a little bit of a momentum sport where if you can get an influential angel, somebody who's influential in the community, who's active, who other people look up to commit, then you can get follower people to commit, right? Because that person, they'll be looked at as having vetted you and your business, probably having established a relationship with you, and that is valuable, right?
Yeah. And every situation is different. Like I'm going to give a story that is not meant to counter that at all, because I think often I have seen that work out. But there was another case for me fairly recently where somebody I knew very well and I really like and I have a lot of respect for basically said that exact same thing to me. They said, "Oh, I'm definitely going to invest. You can tell people I'm going to invest. Here, call these people, tell them I'm going to invest." And I said to him, I said, "You know, I don't know, like, you know, because I'm going to call." I said to him, he said, "Oh, you should call these people." And I said, "Well, if I call these people, or if, you know, from you with your intro, the first thing they're going to ask me is if you're investing. So are you investing? Like, you know, like, because otherwise your intro is not really as good. Because if you intro me and then you say you're not investing, like, I kind of almost don't want the intro, you know, like that doesn't really necessarily help." And he said, "Oh no, you can tell them I'm in for $1 million. Like, I'm definitely in. You can tell them that." And time went by and things changed, and I don't think that person even remembered saying that 6 months later. Like, I remembered it, like I definitely remembered it, but I don't think that person even remembered it. And, you know, honestly, fortunately, I didn't say that. Like, I just wasn't comfortable with it and the way he said it, and I didn't go repeat it, and I really appreciated it because they ended up not investing. I would have felt like such an asshole if, like, I had told all the people that. So, but I have seen that work as well. So I don't want to say, I mean, part of it's you got to read the tone of it. In the situation, I wasn't comfortable with it.
And you need to be respectful, right? That's the other thing is, you know, don't say you have somebody's commitment if you don't explicitly have their commitment, right? Now, and then if somebody backs out later, you know, that's not necessarily your fault, right?
Right. Yeah, that was the idea behind the letter of intent, was to make it slightly more concrete than we were at a bar and you told me you were going to give me $100,000.
Yeah.
Yeah.
It's just, I guess, you know, it's just unlikely that an angel investor is going to sign a letter of intent because, you know, then they're saying I'm making a commitment that I'm really not making, because if they're telling you July, then they're not really making a commitment, right? Something is going on in their life that they want to defer the decision until that point.
And even letters of intent aren't actually binding.
Yeah.
I have a question on transparency. So let's say you have traction, you have like $500,000 contracts or large companies, and you walk into a VC meeting and they ask you, okay, who are your customers? We have a gag order, an NDA that you can't violate by disclosing who those customers are. Like, what's the right course of action to take in that situation?
So when you got the customer, they said you can't disclose it?
So yeah, so for example, I have a bunch of customers, $500,000 contracts, not allowed to talk about who they are to anybody.
No.
Sit across from a VC, what do I say?
I mean, the first thing is, the first step is you tease them. So like you make a list of the, you know, it's like a spreadsheet, right? And it's like, you know, customer, contract length, I don't know, whatever it might be for your business, contract length, monthly amount, you know, like any kind of stat that makes it look like legit. Like, here's my chart about my customers. And then you go through and you just rename them, company A, company B, company C, and like industry, number of employees, like some other stuff about them that lets them see, okay, it's a healthcare company with 1,000 employees that does $500 million in revenue, and their monthly contract value with us is $10,000 a month. You know, like, but then you just replace it with company A, company B, company C. And I've done this like selling my company. You know, where like I'm selling my company to one of my competitors, or like somebody in the space. So like I really don't want to give them a list of all my customers. So the first thing they get is, well, here's what they look like. You know, like I won't tell you who they are, but like this is a list, and you're doing that under a situation where it would be fraudulent for you to give them a list that was like wrong. So like there's some teeth to it, and that's the first step. And so, you know, this is a VC, right? So you might give them that first, and then there's like, then it kind of depends. Like most VCs won't sign NDAs, and certainly not in any introductory meetings or anything like that. Like the general rule's gonna be no NDAs, and most of the time you just have to like, I'll see what Rob says, but you kind of just have to make a judgment call, and you are technically somehow violating your NDA, and you are doing it in confidence that they're a VC and they're not going to tell anybody, and that's their business. And like, you know, you don't necessarily put it on a slide, but you tell them, You're like, okay, I'll tell you, company A is actually Microsoft. You know, like, and like, if you don't write it down, you just say it, or something like that. And that's kind of how you navigate it. And then I have seen, in the scheme of how most people think of this, VCs don't sign NDAs. When you're way into diligence with a VC and they're really thinking about making a big investment and you need to disclose certain things that might be under patent control or other thing like that, I think it's possible that they might do a very specific NDA that just covers this exact thing, like I will not disclose your customer list that you gave me, and they might sign an NDA to cover those kinds of things. Do you have anything to add to that?
Yeah, I generally agree with that. I'd say just some other things to think about. So I think Josh's company ABC is a great deck strategy, right? Like if you're actually emailing a deck to a VC, you're having initial conversations, you really don't want to disclose, that's a fair strategy to anonymize your traction. I think what you're going to run into, if you're having any sort of meaningful conversation with a VC, it's just going to come across as weird that you're not willing to tell them who your customers are. I mean, that's just the bottom line, right? So I think, back to Josh's point, it is going to be a judgment call. And if it's me, when the VC asks me who my customers are, I tell them who my customers are, right? Like they're in the business of being, they're in the reputation business too. And so they're certainly not going to, do anything that's going to jeopardize their reputation. So you just have to believe that there's confidence around that. And then the final thing I would say is you will not raise money from a VC until you tell them who your customers are.
Right.
So at some point along the process, you're going to have to disclose it. And my advocacy would be earlier in the process because it's just going to come across as weird that you're not willing to tell them.
Yeah. And without getting too weird, like you still, if it is under confidence, it's okay to say to them, hey guys, I actually have confidentiality. Like it's important you do. You should say, like it's really important you don't mention this. Like you don't tell them, because if you don't do that, then they might say something about it because you haven't told them not to. But in the end, like I agree with Rob. Most of the time, like you're gonna end up telling them, and you better not. You can't wait too long, or it gets really weird. So.
Speaking of weird.
And we are not lawyers.
Thanks.
Speaking of weird, so legal fees can get out of control, and it's something that we all face.
Really?
Yeah, as we start passing paperwork around.
Yeah.
I'd love to hear your thoughts on how to control that or contain that.
At the early stage, the really simple thing is you use standard docs. Pretty much all the docs you're going to use as a tech startup, in particular, I would say, you should be using standard docs. And there's both docs you could find on the internet. There's the first one was called the Series C documents, and I'm sure there are many other versions that have come out of there since then. Many accelerators publish their documents, make them available. And what I've seen happen here in Austin that really has become somewhat of a standard is, like, for example, Capital Factory has a convertible note, and it's the note template we give to all of our mentors that are investing, to all the companies that go through. With the way our funding works, we match investments, and we'll match whatever our mentors do, but we kind of tell all the startups, like, hey, if you use this one, like, everyone's going to match it because everybody's already improved it. And we've now done it with 150 startups. And so there's 150 copies of this note out there. And every law firm in town has reviewed this note already. And every single one has already put their comments in. And if it comes back again and they have a new lawyer that just joined and they redline the shit out of it, we just send it back. We're like, guys, this is the same note you guys have already approved like 5 times already. Like, forget all those changes. It's the note, take it. And that, I think, dramatically reduces both time and money that gets spent on it. And you should be able to do that early on. Is just use these kind of, use fairly standard docs and things.
I just find lawyers like to tear templates apart.
Yeah, and that's just an important thing where you understand when you give a lawyer a document, their job is to redline it. And they feel like if they don't redline it, they didn't do their job. If they just hand it back to you and say this is okay, then you're like, well, why the fuck do I have a lawyer, right? And so unfortunately, that's a bad dynamic because actually there's a lot of times where you don't want to do anything to it. You just want to take it. And so we could probably do a whole other thing about dealing with lawyers. But yeah, I think using the standard docs is really one of the main things to reduce that and minimize the back and forth. And the other thing is just, when you think about places to get creative or interesting or different, you want your product to be creative. You want your marketing strategy to be creative. You want, your culture to be different and creative. You want your fundraising to be boring and exactly like everybody else's. You do not get creative with your fundraising. Don't think you figured out some better way to go do this. Nothing like that. That scares off investors. Nobody wants to invest in something they don't understand. They want to invest in something that looks just like everything else. Would be my general advice. So and that also keeps your legal fees down.
Yeah, I'd say, runaway legal fees for Series seed financings just shouldn't happen, right? Like,
it should almost be a fixed cost.
Yeah, I think there's a couple ways to do it. If it's a convertible round, that's easy. Convertible note, there is the standard language, right? And whoever your attorney is, if you don't want to use the Capital Factory one, use theirs, right? And it's off the shelf, and there shouldn't be a lot of effort around that. Equity rounds are a little more complicated, right? Because you usually have an institutional investor involved, but again, you can fixed fee that stuff. And I'd say beyond that, don't worry about it. Your Series A, the legal fees are going to come out of the proceeds you raise, and you want to get that right, and so just don't stress over that.
Like how profitable do you guys find angel investing, and like just in general, how profitable is it, and like what is it that you guys as angel investors get out of it, and what do you think like most angel investors get out of it?
That's a good question, actually. Yeah, is angel investing profitable? Probably for the vast majority of angel investors, no. And my personal view on it is every check I write, I assume that it's not coming back. And so, I've allocated, a portion of my net worth to angel investing that I'm okay with it going to zero. I mean, it's that simple. And so why do I do it? Because that sounds like I'm an idiot. This is going to sound really cheesy, but I do it because I enjoy the process of, meeting with entrepreneurs and helping out and being a mentor and establishing those relationships and, wishing 15, 16 years ago when I started my first company that I had the ecosystem that is around all of you. Like, it's amazing. Back then, it's like, $5 million to even start a company. Everything was just more expensive. There weren't accelerators. And so having even mentorship or that ecosystem of support just didn't really exist, or you really had to seek it out. And so I feel like, this is my opportunity to help kind of contribute back to that. Anyway, so that's kind of personally why I do it. But yeah, I don't, if I get lucky, great, but it's all probably going to zero.
Yeah, if you ask, so the CTAN, the Central Texas Angel Network, the angel groups try to study this stuff, and people have done more formal studies. It's hard because it's not public data, so that the data is not perfect. And they estimate that they think an angel investor portfolio done properly, which requires a portfolio approach and certain kind of rigorous things about it, can produce a better return than the stock market, upwards of about 30% IRR, 20 to 30%. And so, that's one possible way where it's a strategy and it fits in their portfolio and it's a financial approach to it. And that I'd say is probably even also a difference between maybe the types of investors you would find there versus what you're going to find around like Capital Factory or Techstars or an accelerator or something. Most of the investors here see it as they're paying it forward. They see it as a way to help other entrepreneurs get started, and they think it's one of the most fun things that they can go do. And they find it super energizing and exciting to meet new entrepreneurs and to be able to feel like they can impact it in some way or be helpful. And investing is like how to actually, like, you can, like, I can only be the CEO of like one or maybe two companies at a time. That's how you can be involved in other companies. Like, if you really want to be involved in another company, like, you put some money in and now you're involved. Like, and you get the investor updates and you're part of the conversation, and that's fun. Like, that people enjoy doing that, especially when it's interesting people that are trying to change the world, right? And I think that's why I do it, and I think that's why people like Rob do it, and like most people here are doing that. Nobody is thinking like, okay, how much am I going to get back from this thing I put in? Like, the flip side is like, none of us have so much money that like we can just like do it without having to try to have a strategy that thinks the money is going to come back. Like, that's how we get to keep doing it. And you have to have something. Otherwise, you could just invest in everything and all your money be gone. And like, I wish I had the rigor that Rob did. I probably am way over-indexed on how much that I've put in.
No, I'm over it next too.
And I do think, you know, and the interesting thing, you know, most of it isn't going to work, and it's as like what they say about the stats is kind of a black swan kind of thing. Like, there's just a couple blips that will probably pay for all of them. And not often, you know, it's very unusual that it's the ones that I thought it would be. You know, like it's often a surprise which ones those end up being. But that's the way this business works. Who hasn't asked questions yet?
So you talked about how you look, instead of looking at users, traction, you look at like revenue. What would you say are the patterns that you see in companies that get funded in revenue generating activities? Is there any common thread, or is it just kind of all over the place?
Just more is better. Recurring revenue is really good, you know, like, I mean, the most common thing we see are B2B SaaS businesses. They're businesses that have a website that's selling something to another business, and they pay a monthly fee to go use that website in some way. And that translates into, you know, recurring predictable revenues, which people like, and generally revenues that just grow because they're paying month to month, so every new customer kind of like adds on to it. Those are really nice, and that's half the stuff that we see. And the range of revenue is for an early stage company, pre-Series A, is typically, I'd say, anywhere from obviously 0, but you know, 10K to 100K in revenue. You know, like.
Yeah, I mean, so the caveat to that, I think that's right. I think the majority of businesses we see B2B SaaS are, you know, transactional in nature, so that you have sufficient volume and repeatability that there's a, you know, reliable uptick month to month or quarter to quarter if a company really does have traction. You know, the exception to that is, you know, us, the business I'm in now is very much an enterprise software sale. So these are 6-figure plus deals that have very long sales cycles, you know, are lumpy, right? Like we may close a deal in January and, you know, 2 in March or whatever. So for that, you know, my hope is for us to go get a Series A done. So we're a seed stage business, raised a couple million about a year ago. You know, my hope is for us at Series A, it's less about MRR and more about momentum, right? Because we are going to close a series of customers in a short period of time, and I'm going to use that momentum, even though our MRR is probably going to be less than 50 or 60K, right? But our bookings number, the number of, you know, our contract value is going to be $1 million, right? So there'll be an opportunity for me to tell a story around momentum.
Yeah, that's a great point. There's just a lot of different types of sales cycles. We work with some healthcare companies, and they're selling to hospitals. Hospitals are enterprise deals, and they take a long time. And like just having a bunch of hospitals interested gets a lot of investors interested. Like, oh wow, you've got that hospital ready to test your thing. Like that's a big deal. And that's more like an enterprise deal. So there's going to be varying markers for your traction.
Square one kind of question. When looking for seed funding, what is the typical timeline we're looking to cover with that round raise, right? I mean, we've, you know, for example, we want to go on and hire a couple salespeople and maybe get some salary for the co-founders of some sort, which is another question.
Don't say any of those things.
Okay. I mean, so, I mean, what kind of timeline should we be looking to?
That's a great question. That really should be another slide. Generally, you want to think about it not as like, and when I said don't say those things, it's like don't say like we're raising money to hire people, because you're not raising money to hire people. You're raising money for what those people are going to accomplish,
right?
And that's what you want to use as the goal.
Okay.
But really, it's milestone based. So you want to think about it like I'm raising money to accomplish something, which is going to effectively raise my valuation and allow me to, it's one of two things. I'm raising money, and with this, I'm going to be profitable. So I don't need to raise more money. That is a great goal. That's a really good one. Not always the right thing for you now, but like that's like, you know, that's good. And then the other one is, I'm going to accomplish something that's going to change my valuation such that it will allow me to raise more money in a way that does not dilute my existing investors. That's like the whole piece, right?
Right.
And what that really typically means is, you know, so there's all these different risks in a business. When you start out, you have all of them because you've done nothing. And slowly as you grow, you tend to eliminate those risks or reduce them greatly. And that's what the VCs are looking for. And so at the beginning, you know, there's execution risk, like can you do anything? Like can you actually get stuff done? And then there's, you know, kind of like customer risk, will the customers pay for it and adopt it, will they use it? And there's market risk, competitive risk, will people, you know, what's gonna happen out in the market that you can't control? And there's possibly regulatory risk if you're Uber or HomeAway or something like that. And then, you know, and there's a bunch of these types of things. And typically, and often with each round of funding, you're focused on de-risking one of those things. So like the first one is like you build something useful, you know, and then you show that people will pay for it. Like, and okay, yeah, people do want it. And then like, you know, and then can you build a scale, can you build a, so common goals might be, we're gonna get our product built and we're gonna have our first 10 customers using it, you know, beta testing it. And then the next one might be, we're gonna get up to with more customers, or we're gonna test a bunch of different customer acquisition strategies and identify what our way we're gonna scale is, like how we're gonna acquire customers. And then after you've done that, the next round of funding would be to then put money into that customer acquisition strategy to get up to 1,000 customers and this much revenue, you know, which kind of shows a different milestone. With each of those, it's because we think we're gonna be able to raise more money after we've accomplished that thing. And that's what you really need to focus on, is what is the thing you're gonna accomplish that's gonna let you raise more money? Okay. And that's the question you wanna be asking of the investors, even in that round, about the next round. Like, okay, like why, like part of how you answer how much money should I raise is by asking investors, not just of this round, but of what the next round are gonna be. What are you gonna wanna see to make me investable then? And that's how, you know, that's part of how you have to set your goals.
Yeah, so there's two of the biggest mistakes I see with you know, entrepreneurs trying to raise their seed round. This is one of them. I'll tell you the other one if you want to hear it. But this one is,
I want to hear it.
This one, you know, if you do nothing else today, internalize what Josh just said. Raising your seed round is not about how you're going to use the money. It is about what are the 3 things you have to accomplish with that money, right? And those 3 things need to be defined by the Series A investor, right? Because, you know, that you've got to hit those 3 things in order to be financeable for your next round, right? And so,
and it's not like they're going to give you an exact answer. They're going to try to waffle around it, but you want to try to like nail them down.
Yeah. So it very much is milestone driven. And so once you know the 3 things, it's working backwards. You know, what do I have to do in terms of hiring, in terms of lead time? You know, I need 12 to 18 months and I need to hire 5 people. You know, that's, and then double it, right? Because that's what it's going to take. So very much milestone driven. It's just so critical when you're talking to investors about how much money you want to raise.
But don't ever, I mean, it's just very, just don't lead with, I'm doing this to hire these people. It's very common that people say that, because that's what they're much in the weeds of, like, oh, this is what I need to go do next, I need to hire these people. But to me, that's like, wait, I'm giving you money so you're going to increase your burn? Like, you know, like, well, you know, that's not sustainable. That just sounds like you're going to need more money, you know, like, right? Like, that's.
Yeah, the key, you know, the mind of an angel investor is, the only thing that's important for an angel investor is that you are going to be able to raise your next round of financing.
Yeah.
Because if you can't, my money's gone, right? So I don't really care about your exit 5 years from now, or, you know, the grand vision that you're communicating and the big idea, because that's highly speculative and who knows if you can execute on that. The only thing I care about, beyond loving you because I have great chemistry with you, is are you going to get your next round of financing done? And so I need to feel confidence in those 3 milestones, right? And that you're raising the right amount of money to get through them.
You've been waiting very patiently. Thank you.
Thanks. I was just speaking, so I'm like pre-product really early, and I was speaking to an investor yesterday, and they mentioned like terms that I haven't fully understood. So just want to, one thing, they said they prefer to do equity than convertible notes. So I'd like to know just the conflict between that. They wanted a liquidation preference like 1x, which I didn't fully understand, and they want like preference for the next round, like, to fill the whole next round.
Okay, those are 3 really good questions and different ones. So the first 2 are probably easy. The third one's probably a lot more nuanced, and we might have some more impact on our discussion on. The first one was equity or convertible note, and they said we prefer equity. So that was the conversation I was having before about equity versus convertible note. They're saying I don't want a convertible note. Was a very common thing to hear 3 years ago or 5 years ago. It's less common now. I know a lot of people that used to say that are now like, they might prefer it, but they realize like they're resigned to like, okay, I'm probably gonna do more convertible notes. It's gotten more popular. In the end, you can look at these different ways. Most investors would probably feel like there's more protections for the investor as under an equity situation, and there's more, and you have more control and more protections under a note, and so they feel a little bit more secure in that, and they know what they're getting. And the and then other people might argue that actually they prefer the note because with the note they actually have kind of like first dibs on the assets. It's like if something doesn't work out, they get paid back first. So there actually are some advantages to the investor the other way. But most people would probably view it that way, that it's a control kind of knowing what you're getting kind of thing. If you're going to do an equity round, if you're going to do a note, you can do a note and you can use a template note and you can kind of take money. I don't want to ever say you can take money from anybody, but like there's not nearly as much to negotiate or to figure out or to screw up. And if you're doing an equity round, it's much easier to screw it up if the other person isn't a very experienced investor. So if that person is not a very experienced investor, I'd be very hesitant to go let them do what they just said, because you're really making a big bet and they can screw it up by setting and make it so that you can't take more investors, because other investors come look at it and they go, oh, this is messed up, I don't want to touch that, right? And so that's why I would kind of hesitate around that initially. And again, through that, they're gonna set all those terms. And if you're dealing with a very experienced investor or a VC, that's all they do all day. And I would trust them to be able to help you set those terms, and like you're gonna work that out together. But if they're not a very experienced investor, they could really easily, they usually will screw it up. Not even they could, they will usually screw it up. Second question was liquidation preference. So that basically says that, hey, no matter what we agree about how much percentage of the company I get, at least I get my money back. And that's a 1x liquidation preference, which is very reasonable. That's not at all unusual to ask for. In fact, I would argue when the capital factory note has a 2x liquidation preference, which I still think is a very reasonable thing to ask for. And that's basically saying, as the investor, like, look, at least I'm gonna double my money. Like, like that's why I'm investing, right? Like, it's like if I don't do that, so it's like if you and this gets into like even like why you don't want to drive your valuation too high or other things like that, because what can happen is you can be in a situation where if you drive your valuation too high, too quickly, so investors invest at a $10 million valuation, well then suddenly like they will not want you, if you got say things don't work out quite the way you expected and you have the opportunity to sell the company for $10 million, most of your investors are going to say no. So like, well, I'm not going to make any money if you sell it at $10 million and you might make a lot of money and you might want to sell it. But if you had raised money at a $5 million valuation, you could still make a lot of money and they could double their money and probably be okay with it. And so there's those reasons to kind of like keep it, to possibly keep it lower. So that was that point. And then on the, what you would typically call that was a liquidation preference. So I'd say 1x, totally standard, like, and totally fair. 2x, I think generally fair for first investors on a convertible note. Once you start getting into like an equity round that's a bigger round, it's usually gonna go to 1x, not 2. So it's really, I'd say just at the very beginning. The pro rata rights, which is the ability to take the next round, I'd be very, very careful about, because that really limits your options and hobbles you. And it's very, very dangerous. So that again gets back to, especially with an inexperienced investor. But there's a lot of downsides to that. Yeah, that's very complicated and will keep other investors from even looking at it.
Could you give them because I kind of would like to give them the opportunity to obviously get in the next round. So is there some
You're going to be able to do that. You can say to them, hey, of course I'm going to let you in the next round.
Yeah. But can you give some right to 10% of the next round, or does that happen? Or
what they normally would get would be very standard. It would be they get the right to maintain their ownership, which is their straight pro rata. I would say, look, if right now you're buying 1% of the company and I raise more money, you'll be able to put in at least as much money to keep your 1%. But what he sounds like he's asking for is he wants to be able to take more.
Yeah.
And your argument as an entrepreneur should be back to say, well, if you want to guarantee you have more of the company, then you should buy more of the company right now. And that's how you can guarantee that you will have that later. But that, if you want to do that, then do that now. Otherwise, I'll guarantee that you'll be able to at least keep the amount that you have. And of course, I'm going to come talk to you about it and give you a chance to invest in that as well.
Okay, thanks.
Yeah. Other questions?
Yeah. I have a question on concern over opportunity size. So we've got something that is in the seed round we have right now is in the tens of thousands. We're chasing an annual revenue opportunity in the hundreds of thousands. It's a pretty small thing. We've been asked to look at the idea of what an A round looks like. My concern is that when we start taking a hard look at what the opportunity size is for the next step up, for example, when you get your examples of how much goes into an A round, okay, if it's $1 million on a $3 million valuation, whatever, there's an expected return that company grows into at some point. So I have to tell the story at some point that this is gonna grow into a company of 30 million, 50 million, X million. And based on what we're seeing so far, we're good at the seed stage. We're good for maybe a few million, maybe even the tens of millions. But the story gets kind of, there's a lot of things that would have to be learned. And it's viable. It's in the e-commerce space. Okay, so it's a huge space, but we're in a really, really small part of the e-commerce space. So the story where we are right now, I mean, so the question then is, when we look at what the opportunity size we'd be looking at for the A round, so to speak, do you have concerns that you have to tell the story? I mean, are there expectations for what the A round needs to be at an exit opportunity size for it to be a competitive deal?
Yeah, so I think I understand your question, which is you've got a niche focus on a particular segment in e-commerce, and you're concerned about the market size of that niche opportunity relative to your ability to get a VC interested in it.
So yes, so yeah, we could expand it. So there's certainly room to expand this project.
Yep.
Okay, but as far as what we know, the path that we're on, you know, the provable path that we know that we can hit. Sure, we could tell a story that we're going to grow and do all this.
Then that's what you should tell. I mean, a VC is doing your Series A is part traction and credibility around your traction, and storytelling is the other part, right? And storytelling is you better have a big opportunity in terms of your vision, and position what you're doing now. Again, I don't know enough about your business for this to be prescriptive, but position what you're doing now as your beachhead, right? Like, you are going to own this very specific thing that you're doing, and by doing that, it opens up this other opportunity or opportunities, and so you're vision casting now, right? You're telling a story of how this thing you're doing now, and I'm a big believer you can't go too narrow to start, right? Like, this is another mistake I see over and over again, or people trying to do too many things. So I think you will be respected for going very, very narrow, as long as you're showing traction that you can really own that narrow thing, and then tell a vision story about how that enables a much broader land grab and market opportunity. But you're going to have to tell a big market size for a VC to invest. I mean, that's just the reality.
And so I totally agree with that, and that assumes you want to go get a VC to invest.
Right. Yeah.
And so that part of that is also the decision of what kind of business am I building. And you aren't going to ever know the perfect answer, and things will often not turn out the way you expected them to. We started WP Engine thinking it was going to be a small lifestyle business, and it's got 300 employees, and it's raised like $50 million, right? That did not work out the way we expected. But you have to pick something, and you kind of need to get your direction. Based on that, it's going to be like where you try to go and what kind of money you try to raise. And so if your thought is like, some people go into it thinking like, well, here's where I'm going to start, but I have this vision and it's where it's going to go. And that's the kind of business that goes and raises venture capital. And if your thing is like, hey, I think I can build a small business that might not support venture capital, but I need investors to get started still, then you're going to probably target different types of angel investors who tend to invest in different types of businesses. The structure of it might even look different. And you'd want to limit the total amount that you raise to avoid raising too much money that you set expectations too high, that you can't deliver on it, that you can't be successful. There's lots of different kinds of angel investors. There's very few kinds of VCs. Like, they typically are trying to hit home runs. That's the only way their model works. But there's lots of kinds of angel investors. And then particularly angel people in your space. So like somebody else that's built a business in your space would be a much more likely angel investor to understand what you do and to be more likely to maybe support you even in building different sizes of businesses than that.
This might tie in with what you were just saying, but one of your charts had the term super angel. I've never heard that term before. Is that just the obvious angel with lots of money, or are there any more nuances?
Super duper angel. No, super angel generally refers to, so I would generally think fall into that category. A super angel is basically somewhere in the middle. They effectively run a small fund of angels. Like, they influence a lot more money than just theirs. So like the Capital Factory Fund is not really a VC fund. Like, it's like a $10 million fund. Like, that's not a VC fund. We're really an angel fund, and this is like a super angel fund. And I would then be like a super angel. And there's other people, like people who have big AngelList syndicates would probably be considered a super angel. But that's what it means. It's like you're actually affecting a group of investors, but really still as an angel. Would you agree with that?
Yeah.
customer strategic investments, are those typically looked at as positive or as a red flag? Because there's probably terms in there that are gonna be restricted for future rounds.
Yeah, so, gosh, this truly is an it depends answer. I would say the way you just positioned it, you had me okay until
Yeah,
the
you
very
put the
last
poison
part.
pill in it.
Right. Yeah, I mean, strategic investments can be okay if they're arm's length and they don't have restrictive covenants in them that are gonna inhibit your ability to raise your next round of money. Again, the way you look at today's round of financing is how is it gonna impact my next round? How do I get the next round done? And so you have to make decisions so that you don't hinder that. And, some strategic investors are good at being strategic investors. They have separate venture funds set up inside their very big companies that do arm's length deals. There are some that just invest off balance sheets, but I would just be very careful of first rights of refusal and dedication to specific roadmaps that are theirs. Certainly anything that inhibits you from doing deals with their competitors. Yeah, I mean, these are all the things you got to say no to. Right?
Yeah. Yeah, so I totally agree with him. And like I said, when it's like your description went like, woo, and it was like, yeah, they're generally viewed as very positive and great, unless they have any onerous terms in them, in which they just become terrible.
Even from the perspective of other customers feeling.
It all depends on how you structure it. It's still massive credibility, and often that might be a reason to try to get two of them involved in it. The main things are, like Rob said, making sure it can't limit what you do in some way that makes you not able to grow your business, or limit it's like whereas some strategic investors will ask for extra rights. In a good situation, you often can negotiate to give a strategic investor fewer rights. And you say, hey, because you're a competitor, because you're a strategic investor in our space, I can't give you information rights. I'm going to give you you're going to get less information than other investors. Because you're that, you can't do certain things. You're not going to have the same visibility. And in general, I've seen it actually work out pretty well. Some recent examples of that. So WP Engine, who I mentioned recently before, Automatic, the creators of WordPress, are an investor in WP Engine. They do not have all the exact same rights as everybody else. It was more like a passive investment, but very good stamp of approval. They're a minor investor, they're not a huge investor, and it was a very good early on that WP Engine could say, we have WordPress behind us, because almost none of the others did, and that was a great credibility thing as they were growing. Another recent example is Student Loan Genius. They just recently did a round of funding here. It's a company that I'm really excited about. They help companies to provide a benefit to their employees where they match student loan payments the way you'd match a 401k payment. And they have a strategic investment as part of this round from Gibraltar Ventures, which is Prudential's investment arm. And Prudential is a big insurance carrier. And they have a separate formal entity set up just to make investments, kind of like Rob was describing. That's what they do, and that's, it's not just a weird thing for them. But as part of it, Prudential is going to sell their stuff, which is like a massive distribution channel for the company. So again, assuming the terms aren't bad, this looks awesome. Like, this is like really good for the company. It's an investment from a strategic partner that's going to go roll them out and sell a bunch of their stuff and grow their business. That sounds great. Like, I was really excited about that.
Yeah, and two more personal examples. So TrueCar was an example where one of the very first investors was a strategic investor. So USAA Insurance in San Antonio, and over the course of, before the IPO, we raised over 100 million, probably 150 million. USAA was the largest investor throughout that period, and they were a great partner. And it was largely because it was arm's length, and we had, partnerships and deals with their competitors all along the way. So that was a good example that worked. Another example of, so my last company, Black Locust, here in town.
I forgot even that one. I skipped that in your bio.
Yeah, so that company was acquired by Home Depot. Well, it didn't start as an acquisition conversation. It started as an investment conversation where we were getting ready to do a Series B. They wanted to lead it, but they wanted a first right of refusal. They wanted, resource dedication to their roadmap, and
And it was kind of like the conversation he was having. You went back and you're like, oh, if you want all that, here's how you get that. You buy the company. Then you have first right of refusal, and you control the roadmap.
Yeah, and again, this is all easier said than done, right? Like that was a scenario where I had institutional interest in raising the money, and so I had leverage to tell them no. In absence of that, it's tougher, right? I mean, you have, here's the savior coming in to, give you $10 million to grow your business. It's tough to say no to that. And so again, a lot of this stuff up here is not black and white, it's guidance. But I'd say be very careful with strategic investment.
Another example I heard recently that I liked was a strategic investor was coming in, and a lot of times the strategic investor will try to get their cake up front. They'll want to get those rights right away, or hey, we're going to be doing this, so we should get extra, because we're going to help you distribute it, or we're going to do something. But a lot of times those things don't work out the way you expected them to, and it doesn't sell the way they thought. They aren't successful at selling. They don't push it. They don't whatever. And so in this case, it was structured whereas the investment was just like every other investment. They were investing like other investors. But they did have some success milestones. And if they were able to drive a certain amount of business and customers and revenue through the business, they could earn some additional equity kickers for that. That made it sweeter. But it was performance-based. And again, that looked like a great deal. That's less common. But that was smart. I was like, okay, that's good. They're coming in like normal investors. Yes, they can sweeten the pot, but only by actually delivering on what they need to go do.
Yeah, that's a really good point. I think, issuing warrants to strategic investors is something that is done where they get essentially more equity for the dollar they put in, but it's not necessarily tied to their investment, it's tied to performance.
Yeah. It's probably time for just one more question, and then about to wrap. Anybody else?
What advice would you give yourself as a young startup from what you've learned today? Maybe something that you did wrong, or you were wrong about, something you learned?
Oh man. Yeah, that's interesting.
Okay. So common advice that I feel that doesn't feel like so much anymore, because I've learned this lesson, but certainly I didn't understand as a young man, and I think a lot of people that I meet don't. Particularly, it really applies to both sides. If you're technical, there's one version. If you're not technical, it's the other. But if you're technical and you're a programmer, then you think, oh, I see a problem. I know how to build that. All I need to do is build that. And the rest is easy. I can build that, and then, wow, I have a company. And that's not having a company. Selling it is what's much, much harder than building it, and building a business around it. And so I just think it's a very common mistake. And I was a young programmer, and I used to just see every problem and think, oh, I can build that, and not realizing, no, building a business is a lot harder than just building the solution. And I think sometimes it's the other way too. A lot of, generally everybody else's work is easy, and your stuff's the hard stuff, right?
Yeah, so I think we're related to that. One of the things I keep, every time I do this, it's like I got amnesia about how hard it is to do it again, right?
It's like childbirth,
Yeah, and the only thing, frankly, that has gotten easier for me has been raising money, because, having done it a few times, it's easier to raise money, right? I'm not a first-time entrepreneur anymore. But it doesn't, there's nothing about, building your company that gets easier, right? Hopefully you have learned a lot and you can mitigate some risk, but it's just hard. So the advice I would give you is, prepare yourself for the most difficult thing you have ever done. It'll probably be the most rewarding too, success or failure, but it takes a personal toll. It is a long slog, and you just have to be prepared for that, and most people aren't.
Great. Well, thanks so much for coming. I hope you enjoyed that. Today is the primaries. If you didn't vote today, I did. I think their polls are probably still open somewhere, so I'd encourage you to do that too. 2 hours left. Also, I want to make a couple quick intros just as you're walking out. A lot of people want to either ask more questions of me or others. So Liz, if you want to raise your hand, Liz did the tour. For those of you on the tour, Liz, if anybody's interested in getting a membership here or getting a desk or an office here, Liz would be a great person to talk to. JD is our venture associate, so he helps run the accelerator program and knows all the companies here and how we invest and things like that. And Arij is also, this is like her first day, so go ask her a lot of questions, and she can help you too. But some other people, that might be able to answer some questions. So thanks for coming.
That was really good.
Oh yeah, so I think this every month. And also cool is, so every month, I get but then it's like a different, usually it's like a C or you or somebody, so it's always Cool.